Welcome to the Deep Dive. Today we're looking at the Massy Group, that big regional player based in Trinidad and Tobago.
Yeah, a huge name. And, well, they've been around forever, really since 1932 as Neil and Massey.
Right.
What's really interesting is this massive shift, this data-driven change they started around 2020.
Exactly. It's quite the strategic puzzle, isn't it? You have this, almost century-old group built up by buying companies all over the Caribbean.
A classic conglomerate strategy, yeah.
And then modern leadership decides to, intentionally break parts of it down. Why do that?
That's the core question.
Mm-hmm.
They move from that traditional model to become a much more disciplined investment holding company. It's a big pivot.
So let's touch on that history briefly. Early on, figures like W. Sidney Knox, they were all about acquiring established family businesses.
And it wasn't just about profit, was it? It was also about building size, stability.
Security? Maybe. Especially with all the political changes happening across the region back then.
Precisely. And that strategy worked for a long time, decades, really. But then things changed. Around 2018, they did this deep dive into their own portfolio.
Okay, an internal review.
A really extensive one. And the data showed something pretty stark.
Which was?
Almost half, 48% of their assets were actually making less money than the company's cost of capital, their WACC.
Below the WACC, so losing value, essentially.
Effectively, yes. Their WACC was pegged at 9.60%. So nearly half the empire, wasn't pulling its weight financially.
Wow. That kind of hard data must have forced a difficult conversation. Was it controversial, selling off bits that were part of the company for so long?
Oh, I'm sure there was resistance, absolutely. These are legacy parts of the business, but, the financial argument was just too strong.
The numbers don't lie, as they say.
Exactly. So they started divesting, selling off units that weren't performing or weren't core anymore, like Massy Technologies, Massy Energy Resources.
And that freed up capital.
A significant amount. About $1.36 billion, which is roughly, US $200 million? And that cash was specifically earmarked for reinvestment into areas where they could get higher yields, better scale, trading that broad base for focused efficiency.
So what does this leaner Massy look like now? What are the main areas?
It's built around 3 core portfolios now.
Yeah.
The idea is synergy, not just, collecting unrelated businesses.
Makes sense. What's the biggest one?
That'd be the integrated retail portfolio, the IRP. It's the powerhouse, bringing in 44% of their profit before tax, their PBT.
And that includes?
Massy stores. They have 68 modern supermarkets across 6 countries, and also Massy distribution, handling consumer goods, pharmaceuticals.
Right, giving them huge buying power, I imagine.
Immense scale advantages, yeah. Then there's the gas products portfolio, GP. That's about 22% of PBT.
What kind of gases?
Pretty much everything. Industrial gases, medical gases like oxygen, specialty gases like helium, LPG too, plus services for the energy sector. Very comprehensive.
Okay, retail gas products. What's the third leg?
The motors and machines portfolio, M&M. That accounts for 18% of PBT.
So cars and heavy equipment.
Exactly.
Yeah.
Major car dealerships. Nissan, Hyundai, Volvo, and Massey Machinery, which is a key CAT dealer for construction and energy equipment.
So the strategy was divest, focus, reinvest in these 3 core areas. Did it work? Is the financial performance validating this?
It seems so, and pretty quickly, too. If you look at the results for the 6 months ending March 31st, 2025, their after-tax profit jumped 20%, up to $365 million.
Yeah.
So, yes, the pivot seems to be delivering measurable results. Discipline management paying off.
That's a significant jump. It brings up an interesting point, though. Does this focus on efficiency and profit maybe strengthen their ability to contribute socially? Or does it detract?
That's a great question.
Yeah.
They seem to explicitly link the two. They have the Massey Foundation, set up way back in 1979 in Trinidad and Tobago.
Okay, a charitable arm.
Right. And the really interesting part is how it's funded. Each subsidiary, every part of the business, has to contribute 1% of its pre-tax profit.
So it's built into the structure.
Exactly. It ensures this consistent funding stream for things like youth programs, education, health, regardless of, discretionary decisions year to year. So the more profitable the core businesses are,
the more funding automatically flows to the foundation.
Precisely. The success fuels the social commitment directly.
So, looking back, Massey's story really presents two different approaches, doesn't it? You had the historical leaders building this huge, diversified group, maybe for security in a changing world.
Building an empire, yeah.
And now you have the modern leaders carefully dismantling parts of it, driven by data, aiming for peak efficiency.
Two very different philosophies of growth and security.
Which leaves a question for you, the listener, to think about. Which approach makes more sense today? Is it growth through sheer accumulation, building that wide base? Or is it growth through this kind of sharp, data-informed focus and divestment? Which model is ultimately better for creating long-term value, both for shareholders and for the wider community in the 21st century?